3:58 a.m. You're the first one on the floor. The lights above the trading desk hum quietly, the kind of fluorescent buzz you only notice when the room is empty. 4 monitors glow blue against the glass walls. Futures are already moving in Asia. Europe will open in 2 hours. New York will follow. You are 24 years old. Your badge says junior analyst. Your job description says research. Your real job is finding something the market hasn't noticed yet. You don't drink the coffee because it's good. You drink it because the senior analyst already finished too. The fund manages just over $10 billion. You don't fully understand what that means yet. Not really. You know the number. You know the headlines when funds blow up. You know the names of the legendary trades everyone whispers about. But you don't understand the scale until the first time you see a position ticket. $280 million. Long. You stare at the number longer than you should. The senior analyst notices. He doesn't look up from his screen. Don't focus on the size, he says. Focus on the idea. That is the first rule of this world. Ideas move money, not effort, not intelligence. Ideas. Your mornings start before the news. Macro briefs, overnight market summaries, central bank speeches from countries you've never visited. You learn to scan information the way surgeons scan x-rays. Fast, precise, clinical. One headline matters, 99 don't. By 6:15 a.m., the floor begins to fill. The portfolio manager walks in last. He doesn't carry a laptop. He doesn't carry notes. He carries questions. Why is energy up 3% in Singapore? Why did credit spreads widen in Frankfurt? Why is copper moving before the data? No one answers immediately. They check their screens first. This is another rule of the system. Confidence is valuable. Accuracy is survival. At 7:30, the morning meeting begins. 6 people around the table. Analysts, traders, 1 risk manager. The portfolio manager stands at the head. No slides, no presentations. Just conversation. You speak twice. Both times your voice is steadier than you expected. You present a small idea. A regional shipping company. Oversold. Balance sheet stronger than the market assumes. The position size would be small. $12 million. You think that sounds enormous. The trader nods slowly. The portfolio manager says nothing. Then he moves to the next topic. The meeting ends. No one tells you if your idea mattered. You learn quickly. Silence is feedback. Your days stretch longer than you expected. Research isn't glamorous. It's transcripts, earnings calls, supply chains. You learn where companies hide their real numbers. Footnotes, segment reporting, deferred liabilities buried in paragraph 6. You build your first full financial model in 2 weeks. The senior analyst deletes half of it. Too complicated, he says. Markets reward clarity. That becomes the second rule. If you can't explain the trade in 30 seconds, it isn't a trade. 3 months later, something strange happens. The portfolio manager asks you a question. Not in the meeting, at your desk. He asks, why is this company trading below liquidation value? You answer carefully. Asset mispricing, temporary demand shock, shipping backlog normalization. He listens. He nods once. Then he turns to the trader. Start a position. $60 million. You don't react. You can't. Your analysis just moved more capital than your entire family has seen in generations. No one celebrates. The screens keep moving. That is when you begin to understand the scale of the machine. You're not here to be right. You're here to be useful to the trade. 9 months in, you witness your first loss. Not a small one. The fund is long a semiconductor supplier. The thesis is clean. Demand growth, tight inventories, strong margins. Then, Taiwan announces export restrictions overnight. The stock opens down 28%. The position size is large. Very large. The floor goes quiet. No one panics. The trader exits half the position in 17 minutes. The loss is $94 million. No one raises their voice. The portfolio manager simply asks one question. What did we miss? That question echoes longer than the loss. Because in this system, losses are not failures. Unexplained losses are. That becomes the third rule. Every loss must teach something expensive. 2 years later, you move up. Your badge changes. Senior analyst. You now own sectors: technology, logistics, energy infrastructure. You learn something interesting about executives. They rarely lie. They simply choose which truths to emphasize. You learn to listen to what isn't said. Margins discussed too quickly. Costs mentioned too vaguely. Confidence that arrives half a second too late. These are signals. Information is rarely hidden. It is usually misdirected. The fund grows. $10 billion becomes $13 billion. Your team expands. 2 junior analysts now work under you. Their questions remind you of your first year. They ask about salary, bonuses, promotion timelines. You answer politely, but you know something they don't understand yet. This industry doesn't reward time. It rewards conviction under uncertainty. That becomes Rule 4. If your idea doesn't scare you slightly, it's too small. 3 years later, the portfolio manager calls you into his office. It's the first time you've been inside. There are no screens, just one window. The skyline fills the entire wall. He asks a simple question. If you had $500 million, where would you put it? You answer slowly this time. You talk about global freight bottlenecks, underbuilt port infrastructure. You talk about energy demand in Southeast Asia. You explain the structural imbalance. When you finish, he waits a moment. Then he says, "Write the trade." 2 weeks later, the fund enters its largest position in 5 years, $420 million. Long. Your thesis. You sleep poorly for the next month. The market doesn't move. Then it moves suddenly. Up. Fast. 6 weeks later, the position is worth $610 million. You understand something important that day. Not about money, about responsibility. Because when a trade works at this scale, the numbers stop feeling abstract. But the ladder continues, and the next level changes everything. The promotion is quiet. No announcement, no speech, just a new title in the internal system. Portfolio manager. You now control a book of capital. Not ideas, capital. Your allocation starts at $1.4 billion. You spend the first week doing something unexpected. Nothing. You read. You observe. You watch how the other portfolio managers behave when markets move. One sells quickly. One doubles down. One barely trades at all. Their styles are completely different, yet they all survived long enough to reach this floor. That's when you learn the fifth rule. There is no single way to win in markets, only ways that eventually fail. Your job now is to delay failure as long as possible. The pressure changes immediately. Before, you were responsible for ideas. Now, you are responsible for drawdowns. Investors don't ask how much you made. They ask how much you lost when things went wrong. Your risk manager sits 2 rows behind you. He watches exposures the way air traffic controllers watch aircraft. Position sizes, correlation clusters, volatility spikes. Your portfolio moves billions through dozens of instruments. Equities, options, credit, commodities. Some trades last months, some last 6 minutes. The trader beside you executes them without looking surprised. You notice something about great traders. They don't celebrate good trades. They forget them immediately. Memory creates hesitation, and hesitation costs money. Your first quarter is uneventful. Steady returns, up 4%. Then something happens in the bond market. Not a crash, something quieter. Liquidity begins disappearing. Treasury spreads widen in places they shouldn't. Swap markets stop behaving normally. It's subtle. Most investors miss it, but you've spent weeks studying balance sheets from regional banks. Their funding costs are rising faster than reported. You call your trader. Reduce exposure to financials. The position exits slowly. 3 days later, a mid-sized bank announces emergency funding measures. The sector drops. Your book avoids a $210 million drawdown. No one celebrates. The portfolio manager next to you simply nods once. In this world, survival is praise. 6 months pass. Your returns compound. Investors begin noticing. Pension funds, endowments, family offices. They don't call you directly yet. They call the founder of the fund. But they ask about your strategy, your trades, your discipline. The founder calls you into his office one afternoon. He has built this fund over 23 years. You've spoken to him fewer than 10 times. He pours 2 glasses of water. Then he asks something strange. Do you know what investors actually buy from us? You answer cautiously. Performance, alpha, risk management. He shakes his head. No. He waits a moment. They buy belief. That becomes the 6th rule. Capital flows toward conviction, not certainty. Conviction. Your allocation increases. 1.4 billion becomes 2.7 billion. Your team grows. 3 analysts, 1 dedicated trader. Your days become shorter, not because you work less, because thinking replaces activity. You spend hours doing nothing visible, looking at charts, macroeconomic data, trade flows between countries. You start noticing patterns, shipping routes tightening before commodity shortages, currency movements predicting political tension. Capital moves before headlines do. Always. The market rarely predicts the future, but capital often prepares for it. One morning you see something strange in energy markets. Not prices, storage capacity. European gas reserves are falling faster than seasonal patterns suggest. Demand hasn't changed, supply hasn't changed, but inventory is disappearing. You call 3 analysts. They check pipeline flows, weather patterns, industrial consumption. Nothing explains it, except one possibility. Someone is accumulating supply quietly. You start building a position, slowly. Options first, then futures, then equity exposure through energy companies. The total position reaches $870 million. Your risk manager calls you. Explain the thesis. You do. He listens. Then he says something you'll remember for years. If you're wrong, this will hurt. You nod. If I'm right, you say quietly, it will matter. 3 weeks later, geopolitical tensions escalate overnight. Energy prices explode. Your position becomes the most profitable trade in the fund's history. Profit? $1.2 billion. The number spreads through the building quickly. Analysts walk past your desk pretending not to look. The founder stops by once. He doesn't congratulate you. He simply asks, "Are we out?" You shake your head. Not yet. The trade exits gradually. Your share of the profits becomes part of the fund's internal performance pool. You don't see the money immediately. That's another difference at this level. Compensation becomes long-term alignment. Deferred payouts, equity stakes, performance carry. Your income stops looking like salary. It starts looking like ownership. Your reputation grows quietly. Other funds start noticing. Prime broker sends research to your desk before anyone else. Investment banks call with early looks at deals. Information begins flowing towards you. Not because you asked, because information prefers useful destinations. That becomes the 7th rule. Access compounds faster than money. But markets are patient teachers, and eventually they remind everyone of their limits. One afternoon, volatility surges unexpectedly. An emerging market currency collapses. Your portfolio has indirect exposure through 3 positions. Not obvious exposure, second-order exposure. The type that only appears when systems break. Your book loses $430 million in 48 hours. You close positions. You hedge what remains. The bleeding stops, but the damage is done. Investors notice. Drawdowns travel faster than profits. A week later, you sit in an investor meeting. A pension fund representative asks a polite question. How confident are you this won't happen again? You answer honestly. It will happen again. The room goes quiet. Then you explain something most investors already suspect. Markets cannot be controlled, only navigated. The meeting ends. The pension fund increases its allocation 2 months later, because honesty in this industry is rarer than returns. Your allocation eventually crosses $5 billion, half the fund. You now influence almost every major trade the firm executes. Analysts prepare research for you. Traders execute your strategies. Risk managers monitor your exposures. But one thing has changed the most: your relationship with uncertainty. At the beginning of your career, uncertainty felt like danger. Now it feels like terrain, something to move through, something to shape. Because at this level, you stop reacting to markets, you begin positioning ahead of them. And that's when the real power structure of the hedge fund begins to reveal itself. Because above portfolio managers, there is still another layer. The level where capital itself begins to move differently, where funds stop reacting to markets and begin quietly influencing them.
The transition to partner is almost invisible. No announcement, no new office, just a different line in the partnership agreement. Equity holder. You now own a piece of the fund itself, not just the trades, the entire machine. The analysts still arrive before sunrise. The traders still stare at screens for 12 hours a day. But your role has shifted again. You are no longer managing a portfolio. You are managing capital relationships. Because at this level, the fund doesn't grow through trades alone. It grows through trust. The number crosses $25 billion in assets, then $40 billion. Your investor base changes. The early capital came from family offices and pension funds. Now the calls come from institutions that think in decades. Sovereign wealth funds, national pension systems, insurance conglomerates. Their allocations aren't $50 million. They're $2 billion, sometimes more. You notice something interesting about investors who control that much capital. They rarely ask about returns first. They ask about discipline, because they already understand something most retail investors never learn. Returns are temporary. Process is permanent. You travel more now, not to factories or company headquarters, to private meeting rooms. Zurich, Singapore, Abu Dhabi, New York. The meetings are quiet. 4 or 5 people around the table. No presentations, no slides, just conversation. They want to understand how you think, not what you trade. How you think. Because when institutions allocate billions, they're not buying trades, they're buying judgment. One evening in London, you meet with a sovereign wealth fund delegation. They control over $700 billion in assets. The conversation lasts 2 hours. Markets, geopolitics, energy transitions. They ask you about inflation 10 years from now. You answer carefully, not because the answer matters, but because the reasoning does. At the end of the meeting, one of them says something quietly. We prefer managers who think structurally. 2 months later, they allocate $3 billion to your fund. Your capital base jumps again, and with it, your influence. The trades change at this level, not in complexity, in scale. A typical position used to be $200 million. Now it's $3 billion, sometimes more. You begin noticing something strange about markets. When your fund builds positions quietly, prices start moving before the news arrives. Other investors follow the flow. Algorithms detect volume. Analysts write reports. The market begins reacting to positioning that began in your office weeks earlier. You're not manipulating anything, but your presence is large enough that the line between observation and influence becomes thin. That becomes the 8th rule. Size creates gravity. Capital of this scale bends markets slightly towards itself. Your schedule changes again. Less trading, more strategy. Monthly investment committee meetings replace daily trade decisions. 5 partners around the long table. The screens are gone. Just printed reports and conversation. You debate allocation shifts, emerging markets, energy transitions, credit cycles. Each decision moves billions. No one rushes. Speed matters in trading, but at this level, patience compounds faster than urgency. The fund's reputation grows quietly. Prime brokers compete for your business. Investment banks offer early access to deals. Governments invite your team to economic forums, not because you make policy, but because large capital allocators influence where capital flows next, and where capital flows, economies follow. One year, the fund identifies something unusual, a structural imbalance in global copper supply. Demand from electric infrastructure is rising faster than mining production. The imbalance won't appear in headlines for years, but you see it forming. The fund begins accumulating positions, mining equities, long-term futures, infrastructure financing tied to production.
Over 18 months, the exposure reaches $9 billion. The trade becomes one of the largest commodity positions in the industry. Then, global demand accelerates. Prices surge. Your fund exits gradually. The profit is enormous. But what stays with you isn't the number. It's the realization that large capital, applied patiently, can reshape entire sectors. Yet power in markets carries a strange side effect: isolation. Your social circle shrinks. Not intentionally, it simply happens. Conversations outside finance begin to feel disconnected from your reality. Your world revolves around capital flows, interest rate decisions, commodity cycles. Most people's worlds do not. So the circle narrows. Other partners. A few friends from earlier in your career. That's it. At the highest levels of finance, access expands, but trust contracts. Time moves faster than you expect. Years pass. The fund crosses $80 billion, then $100 billion. New analysts join every summer. 22 years old, first job on a trading floor. They stare at position sizes the way you once did. $1 billion still looks impossible to them, just like it once did to you. Sometimes you walk through the research floor late at night. The lights are dim, most desks are empty, but a few analysts are still there, reading, building models, trying to find something the market hasn't seen yet. You recognize that hunger. You remember it clearly. One evening, you stop behind a young analyst's desk. He doesn't notice you first. He's studying a commodity report. 3 screens open, spreadsheets everywhere. You ask a simple question. What's the trade? He explains the thesis carefully. Supply shock, underpriced volatility, potential demand spike. You listen. The idea isn't perfect, but the thinking is solid. You nod once, then you walk away. The next morning, the idea appears in the investment meeting. A small position begins forming. $50 million. For the analyst, it will feel enormous, and the cycle continues. Because the machine doesn't stop, not for individuals, not for markets, not even for the partners who built it. Somewhere in a glass building before sunrise, a junior analyst opens his terminal for the first time. The screens flicker to life. Markets begin moving across continents. Currencies shift. Commodities trade. Capital flows through thousands of decisions happening at once. The analyst thinks this world is about intelligence, or ambition, or long hours. He believes the system rewards effort. And in some ways it does. But what he doesn't understand yet is what the system truly rewards: conviction, discipline, patience, and the rare ability to remain calm while billions move around you. The market opens, the numbers start changing, and somewhere inside the machine, another career quietly begins.